Welcome to another episode of Katina Weekly News. Former President Donald Trump is making headlines with a bold new plan, a $280 trillion US Bitcoin reserve. He says it's all about strengthening the dollar while tapping into Bitcoin's skyrocketing value. Experts believe this initiative could guarantee up to $81 trillion, slashing the national debt and positioning the US as a leader in the booming digital asset market. Advocates are calling it a game changer for America's economic future. As we approach 2025, the global economy faces growing challenges despite some post-pandemic recovery. Potential US trade tariff, ongoing geopolitical tensions, and China's economic slowdowns are creating uncertainty. Developing nations are feeling the pressure, grappling with rising debts and trade struggles. The IMF is urging caution, highlighting persistent inflation, concerns that could impact us all. While it is not doom and gloom, these risks remind us how interconnected our world is. A stark warning tonight from renowned market expert Poised Sharma. He says the US is edging towards a dangerous debt bubble. Federal debt has surged to historical levels, with the annual interest cost nearly $1 trillion. Sharma cautions that investors may soon demand higher rates, which could force the government to tighten spending. Rising financial risk, he says, could even challenge America's global economic dominance as early as 2025. It is a sobering outlook, but one that experts says it's a call to action for policymakers. In a surprising twist, Donald Trump might hit the ground running Inauguration Day with a bold executive order on cryptocurrency. Rumors suggest his policies could include creating a Bitcoin reserve, forming a crypto advisory council, and boosting a digital banking protections. For crypto advocates, Paul Atkinson is also tipped to replace Gary Gensler as a SEC chair, a signal of big changes ahead for the industry. Trump has promised to make the US a leader in the digital assets with crypto-friendly rules. News from Japan. The country is protecting a positive output gap of 0.4% for the first time in 7 years. What does this mean? Well, Japan's economy is expected to operate above its full potential next financial year. With 69 million workers fueling a tight labor market, supply growth remains a challenge, but inflation is expected to ease from 2.5% this year to 2% in 2025. The Bank of Japan will be closely monitoring these trends to fine-tune its policies. So durable good orders for this month came at negative 1.1%, which is quite a bit lower than the forecast of negative 0.3%. And it's a sharp drop from last month's 0.8%. Decline in durable goods orders often point to businesses holding back on big investments, which could signal caution in the manufacturing sector. It might even hint at a potential economic slowdown. It's worth keeping an eye on these trends, as these numbers often reflect broader business confidence, and right now they are showing some hesitance. Latest consumer confidence numbers are in, and they show a bit of dip from expectations. The forecast had consumer confidence peaked at 112.9, but the actual figure came in lower at 104.7. That also a slight step down from last month 112.8. So what does this mean? Well, When consumer confidence drops, people tend to be a little more cautious about spending. And since household spending is such a big piece of the economic puzzle, this could slow things down a bit. Think retail sales and even overall GDP growth. Let's talk about new home sales. The forecast was 666,000 and the actual number came in just slightly under that, 664,000. That's a pretty close, don't you think? For some perspective, last month's figure was 627,000. So we are seeing a nice bump in activity. This tells us housing market is holding steady even with the moving parts of today's economy. It is a sign that people are still feeling confident about making big investment like buying a new home. Stability like this always good news. The latest updates on the 2-year note auction, the actual yield came in at 4.3%, a bit higher than the last one at 4.2%. While there wasn't a forecast to compare it to, this slight increase suggests a touch more demand for these short-term notes compared to before. Now, higher yield like this mean borrowing cost for the US government and businesses will inch up. This could slow down the economic growth a bit as everyone adjusts to the higher cost. It is a little nugget, not a full push, but worth keep an eye on. The 5-year note auction brought some interesting insights. The actual yield came in at 4.4%, up from the previous 4.1%. This suggests that investors are asking for higher returns on these medium-term government notes. It could hint at some growing unease. Investors might be feeling a bit cautious about the medium-term outlook of the economy. Continuing jobless claim forecast expected claim to come at 1.88 million, but the actual figure landed slightly higher at 1.91 million. That's also a bit up from last week, 1.86 million. The increase suggests more people are staying on unemployment benefits, which could be a sign of softening the labor market. The latest economic data on the initial jobless claims, the forecast was 223,000 and the actual number came in slightly lower than 219,000. Compared to 220,000 from last report, this means fewer people filled for unemployment benefits than expected. Always a good sign. The close alignment between the forecast and the actual figures suggests a steady trend in the new employment claims, pointing to stability in the market. It is a reassuring indicator that for now, but there's no significant spike in layoff. Crude oil inventory report. The forecast had predicted a decline of 0.7 million barrels, but actual figure showed a much larger drop of 4.2 million barrels. That's quite a contrast, especially when compared to a previous reading of negative 0.93 million barrels. A larger than expected drop like this often signals stronger demand for crude oil or tightening the supply. It's a reminder that energy markets are always dynamic and this could influence oil price moving forward. All in all, this is a significant shift, highlight that growing demand of crude oil, which could be an indicator of heating economy or seasonal factors at play. The latest goods trade balance report, the actual figure came in at negative $102.86 billion, which is slightly worse than the forecast of negative $101.3 billion and notable drop from the previous figure of negative $98.26 billion. This suggests that imports were stronger or exports weaker than expected. It is a sign of shifting dynamics in international trade, which could reflect changing consumer demand or global economic trends. Thank you for joining with us for this week's weekly news. Looking forward to see you in the next episode.